to Descriptive Analysis of Financial Statements Session 6. So today we are going to discuss about subunit 3.3 called the classification of ratio analysis. So in previous class, we have seen that subunit 3.1 and 3.2, which is the introduction, meaning of and features of our ratio analysis. Okay, and later we seen that what are the advantages, disadvantages, and the classification of ratio analysis. Let us understand in this unit what are the classifications are available, and in that what kind of ratios will be available and their formulas, and let us understand what all things will be included in the ratio classifications. Okay, so I'll be sharing my PPT for the information. I hope my PPT is visible. Okay, so subunit 3.3 tells us that understanding of classification of ratios. So you have seen in previous class there are so many ratios classified, that is liquidity ratio and liquidity ratio, capital structure ratio on the basis of financial management or objective of financial management. So there are four classifications, that is liquidity ratio, capital structure ratio, turnover ratios, and profitability ratios. So we all seen this, what all these ratios will be indicating and how it will be relevant to our financial management. Let us understand what is there in the liquidity ratios. So the term liquidity means the ability of a firm to meet its current liabilities. So which means that it tells us that what is the liquid cash available, or else how much time we can convert our assets into liquid cash. Okay, so which will tells us that whenever any kind of situations comes, so how much ability a company is having, that when it can turn it into a, whenever the obligations come, how much they can pay it off. Okay, so usually we call it as a short-term financial analysis. It is called as a short-term financial things. So short-term financial, where very less time, where we need to settle our obligations. Okay, so the important liquidity ratios are, so in this liquidity ratio there are so many important things are there. So first one is current ratio. So current ratio, which is also called as a working capital ratio. So working capital is nothing but the capital or the money which is used in a company for a working, whatever the requirements of a companies will be there to fulfill that, the amount which is kept aside, that is called as a working capital ratio. Okay, so here the what all things will be there in a working capital ratio. So what it tells us that this ratio is most commonly used to perform the short-term financial analysis. So this ratio is what it is commonly used to perform the short-term financial analysis, whatever the short-term financial analysis will be there. So for that it will be used, means whatever the requirement of a short-term financial requirement, whatever the obligations are there related to short-term financial related, so there we can fulfill it. So there this ratio will be most commonly used to perform the short-term requirement of a financial analysis thing, and also known as the working capital ratio. This is also known as what, the working capital ratio as well. So which will matches the current assets of the firm to its current liabilities, which will be matching the current assets and current liabilities. Current liabilities are short-term obligations and current assets are to fulfill that obligations, whatever the assets or whatever the revenue we have, that we call it as a current assets and current liabilities. Okay, so there is a formula they given to calculate the current ratio. So current ratio or working capital ratio is equal to current assets divided by current liabilities. So whatever current assets were there in our business, so like cash in hand, cash at bank, stock, and debtors, bills receivables, and any kind of investments which are there in a short-term period, or any loans and advances which we paid to our employees. So those all are what, our current assets. Okay, and what will be the current liabilities, like creditors, bills payable, and bills payable, and any kind of loans and advances we are received from any of our any of our higher authorities or any of the persons we have received it, so that will be called as a current liabilities. So current assets and current liabilities are having very shorter duration of time, which will be converted in a within 1 year of time. Okay, so that is what the current assets and current liabilities tells. So the current ratio of 2:1 indicates the satisfactory short-term solvency. So what it means that if, for example, 2:1, we can say that if I have a 1 rupees of debt, so then I can pay, I should have the 2 rupees of current assets with me, where I can pay my debt and where I can run my business. Okay, so that 2 rupees will be what happen. See, for example, if you have a 1 rupee with you, so that you can, what you can do, you can if you have a 2 rupee with you and you have to pay 1 rupee to your friends, so that what will happen, you can pay that 1 rupees and you can fulfill your requirements with that 1 rupee. Like that, a business or a firm should have the 2 rupees with them, where they can pay the 1 rupee as a debt or short term obligation. Likewise, if any liabilities are there, they should have excess of, they should have more than that. Okay, that obligations, that short term obligations, more of that, they should have the short term assets or short term uh, revenue, where they can fulfill it. That is called as a current ratio, which will be telling us the, this is the satisfactory level where we can understand it. Okay, so next one is quick ratio. So what is quick ratio means? It is also known as a acid test ratio or a liquid ratio. It is also told, it is also called as a acid test ratio or a liquid ratio, where which will be tells us that what is the satisfactory, what is the liquidity assets we have, what are the quick assets where which can be converted. It is more severe test of liquidity of a company than the current ratio. It is what, it is a more severe test. It is a very more important, severe in the sense very much important test of a liquidity of a company, that how much a company's current assets or current liabilities can be converted into the liquidity form. Okay, it shows the ability of a business to meet its immediate financial commitments. So it shows what, it shows the ability of a business, it shows the ability of a business to meet its immediate financial commitments, whatever the immediate financial commitments are there, whatever the immediate obligations of a financial obligations of a business are there, to meet that, to fulfill that requirements, or to fulfill that obligations. This will be shows the ability, whether this company is having a ability or not. This ratio will tells about the ability of a company, and it is used to supplement the information given by the current ratio. So it is also what, it is used to supplement the information. So whatever the informations are there, for that it will be given by the current ratio. It is used to supplement the information. So whatever the information, it is whatever the information are there, whatever the information or whatever the requirements of a current ratio given by the current ratio, it will be gives the supplement, means it will help you, helpful for that. It will give the supplementary information, whatever the supportive information will be there related to the given by the current ratio. It will give, it will use that, it will use that information from the current ratio. Okay, this ratio uses the current ratios supplementary information which is provided by the current ratio. Okay, next, quick ratio of 1:1 is considered to represent a satisfactory current financial position. So what it means that whatever assets, quick assets or liquidity of assets will be there, that is to be meet with the available liquidity obligations. Okay, whatever obligations are there, current obligations are there, it should meet to that. Okay, means it should be equal, it should not be less than that or more than that, it should be equal. If it is more than that, then it will be treated as the current ratio. If it is equal, then it will be told as a current quick ratio. Okay, you can see the formula there. The quick ratio is equal to quick or liquid assets divided by quick liabilities. Okay, so this is the ratio formula, where we can with this we can find out the quick ratio of a company, which will tells us the satisfactory level of a financial position. Okay, next is capital structure ratio. So capital structure ratios, the next important term is these are two about the liquidity ratio, and next one is capital structure ratio. The next important concept or next important classification is capital structure ratio. So these ratios are also known as a gearing ratios or a solvency ratios or a leverage ratios. So which means what, it will shows that how much is a how much a company can survive, what is the durability of a company. So best way is what is the durability of a company. This ratios is known, so this ratio is also known as a gearing ratios. Gearing ratio in the sense you may say in a car that how much a gear will be available, means how much term it can go, how much speed it can go. That is what it shows the in a speedometer as well as and the gear, what kind of what level the car can go. Okay, for example, in first gear what will happen, in second gear what will happen, in third, fourth, fifth, sixth, like it will tells us that. This ratio also tells us that what if a company have this much of capital structure, so how much it can survive, what is the survival or a solvency of a company. Okay, so the important capital structure ratios are, so in that there are so many important capital structures are there. So the ratios which are available in this are debt equity ratio. So this ratio attempts to measure the relationship between the long-term debts and shareholders funds. So it helps us that to meet the measures, it will help to attempt the measure of a relationship between the long-term debts and as well as the shareholders fund. So what are the long-term debts we have and what is the relationship between long-term debts and the shareholders funds. So long-term debts are nothing but it may be debenture holders, or else it may be any kind of secured loans, unsecured loans, and any kind of loans we are taken for a long-term period for a survival of our company. So that will be tells us about the debt equity ratio, that will be known by the debt equity ratio. The formula for debt equity ratio is debt equity ratio divided debt equity ratio is equal to long-term debts divided by shareholders fund. Shareholders fund is what? It is a fund which is invested by the shareholders or the shares which is holded by the people or a public who are investing in a company, okay, with the little amount. That will be known as the shareholders fund. And long term debts are what? Which is having a more than a year, okay, which is with the loans or the obligations which a company had for a more than a year, which will be provided by, which will be issued by some other people. It may be a bank, investors, or any finance companies, or any debenture holders, any companies, any clients, or any business houses. So those can become a long-term debt holders. Okay, so the debt equity ratio of 1:1 is generally acceptable. So what it means, the debt equity ratio of 1:1 means it can meet the like if it is I have a 1 lakh rupees of a long-term debts, so I can also have the shareholders funds of a 1 lakh rupees also. So like that it is equivalent here. So that can be acceptable if it is like this format. So we can accept that. So the company is having a long-term solvency ratio. Okay, next comes the proprietary ratio. Proprietary ratio is what? This is a variant of a debt equity ratio. This is another term of a debt equity ratio which will measures the relationship between the shareholder funds and the total assets. So what is the total shareholder funds we have and what is the relationship between that shareholders funds and to the total assets of a company. Here all the fixed assets and all the current assets, investments all together will be calculated. Okay, so the formula for proprietary ratio is equal to shareholders fund divided by total assets. So shareholders fund, what all shareholders funds we have, and total assets like in the sense building, plant and machinery, land and furniture, fixtures, fictitious assets, investments, machineries, and any kind of vehicles or any kind of investments we have made, any loans and advances, stock, debtors, bills receivables, and any kind of assets will be there, that will be recorded as a total assets. Okay, next, this is about the proprietary ratio. Next is capital gearing ratio. So this ratio is the this is the ratio between the fixed interest bearing securities and equity share capital. So fixed income securities include debentures and preference share capital. So it will tells us that what a company had an investment in the different companies where it can generate the fixed income securities, which will generate the fixed income. Okay, for example, I can say the deposits, fixed deposit of a company. For example, I have a one company and I had deposited some 2 crore rupees in a bank. Okay, for example, Canara Bank, I had deposited 2 crore on my company's name as a fixed deposit. Okay, from that I can earn some around 6% of interest on that. So on that 2 crore, 6% of interest every year I am going to get. So that is what my fixed income security which I kept for a security purpose, where I can meet the long-term requirement. Okay, so likewise, there are so many other fixed income securities are like in debentures. So I am a debenture holder of another company. For example, I am having a company name of ABC Limited, and the another company is, for example, my friend is having XYZ Company Limited. Okay, so there I am a debenture holder. I am helping him to generate his revenue. Okay, so for that, what I'll do, I will become a capital, or I will become an investor in the form of holding the debenture. Okay, so where I am generating the revenue. So the usually what will happen, the debenture holders will be having 6% of interest rate or 11% of interest rate. Okay, so this can be help us the fixed income securities where I can get the debentures on my debenture holders. Whatever the debenture capital will be there, on that I'll get the 6% or 11% or some fixed percentage of interest rate. I'll be getting the interest on that debenture, which will be written for me, which is an income for me. Okay, which is fixed also. Next, preference share capital. So what will happen? Preference share capital, same thing, where I'm not having a debenture holder, I'm become a preference shareholder, where preference will be given whenever a company earns a profit. So here the preference will be given to the preference share capital. Means whatever the company earns a profit on that, in that certain percentage of interest will be, certain percentage of dividend will be distributed to that preference share capital. Okay, so this is the preferential capital, and it will tells us the relationship between the fixed interest bearing securities and the equity share capital. So what is the relationship there? Okay, so the formula is capital gearing ratio is equal to fixed income securities divided by equity share funds. So what is the differences? What is the major differences we are getting, or what is the major relationship between the both the equity shareholders fund and as well as fixed income securities? So this is about capital gearing ratio. And next is turnover ratio, very important one, turnover ratio. So this is another classification of our ratio analysis. Turnover ratios are used to indicate the efficiency with which assets and resources of the firm are being utilized. So turnover ratios will what? It will indicate the efficiency of a company, that where we can assets and resources of a firm can be utilized, how much we are utilizing the assets and our resources, where we can generate our company's efficiency. Okay, so this is what the turnover ratio tells. So the turnover ratio having very important ratios like inventory turnover ratio. So what do you mean by inventory here? Inventory, stock are both same, where we have a produced some goods which are kept as a stock in our godown, okay, or in a warehouse. So that will be called as a inventory, which is with me, which are with me. That is called inventory. Okay, so this ratio is calculated by dividing the cost of goods sold by a average inventory. So what is average inventory available with me in the business? That is what the average inventory in the sense with some raw identifications. Okay, so cost of goods sold in the sense at what cost my goods would be getting sold. Okay, so I produced certain goods. For example, I'm producing a mobile. Okay, so I am producing today, I'm producing 100 units, or for an entire year I'm producing 1000 units of mobile phones. So where, at what cost I'm selling that? Okay, that mobile will be including all manufacturing, retails, and everything will be included, tax gigs, everything will be included. At what price I'm selling? For example, 12,000 I'm selling a mobile, so that is what my cost which I am going to sell a goods. Okay, so that is what cost of goods sold. It will be taken average of the goods, whatever the goods I'm selling, whatever the units of goods I'm selling, their total cost will be taken for that. Okay, so here the formula is inventory turnover ratio is equal to cost of goods sold divided by average stock or a inventory. So whatever stock are available, that value and the cost of goods sold value will be together calculated. So there we can understand that what is my inventory turnover ratio. So using my inventory, how much I can get the turnover on that. Okay, next is debtors turnover ratio. So this is also very important. So debtors turnover ratio indicates the relationship between the net credit sales and the trade debtors. So it will tells us the difference between, it tells us the actual relationship between what are my net credit sales, what I am selling on a credit basis, where one of my client is very much regular to me. So how much credit sales I'm doing to him, and what is my total debtors, how many debtors, how many credit I have to receive back. Okay, so if I lent money to someone, so I'll become a creditor, I'll become a debtor for him, I will become a creditor for him, and he will become a debtor for me. Okay, so creditor is what? Who is lending the money, and debtor is what? Who is returning back that credit. So this is what the major difference between debtor and creditor. So here credit sales how much I am going to do, and what are the debtors I am going to receive from my clients, which I to whom I sold the goods on a credit basis, right? So the formula is debtor turnover ratio is equal to credit sales divided by average debtors. So it will shows the rate at which the cash is generated by the turnover of debtors. So by turnover of debtors, how much cash we can generate, at which rate, at what rate we can generate. So this is about the debtors turnover ratio. Next comes fixed assets turnover ratio. So fixed asset turnover ratio indicates the efficiency with which the firm is utilizing its investments in fixed assets such as plant and machinery and land and building. So it will tells us the efficiency, that how much I am utilizing my investments in a fixed assets. So in investing in a fixed assets, how much I am utilizing that. Okay, so such as plant and machinery and land and building. So this will tells us that by having that fixed assets, how much I'm utilizing the investments. So fixed asset turnover ratio tells about the formula is sales or cost of sales divided by net fixed assets. So sales, how much I sales did for a year, and what are the total net fixed assets I am having. Okay, next is capital turnover ratio. So this ratio shows the relationship between the cost of sales or sales and the total capital employed. How much capital is employed within the business. Okay, so the formula for capital turnover ratio is equal to cost of sales or a sales divided by total capital employed. So this is what the capital turnover ratio tells. Next, profitability ratio. So what do you mean by profitability ratio here? Profitability ratios are the another classification of a business. So where profitability ratios tells us the total efficiency of a businesses. So in that, the one is gross profit ratio, which will tells us the relationship between the gross profit and the net sales. So how much net sales I made and what I generating the gross profit. Okay, gross profit ratio is equal to gross profit divided by net sales into 100, by which I can identify, or I can have a brief idea about how much gross profit I made for the year. Next is net profit ratio. So net profit ratio indicates the efficiency with which a business is being managed. So how much I am going to manage my business. In that, again, net profit ratio, there are two ways. One is net operating profit ratio and the another one is net profit ratio. So net operating profit ratio tells us that what is the operating profit on a sales, what is actual profit we are generating from the sales. Okay, so net operating profit ratio is equal to net profit, not net operating profit divided by net sales into 100. So this will be helps us to understand what is the net operating profit we are generating on our sales. Next is net profit ratio. So this ratio of a net profit to net sales. So this is the ratio of a net profit to net sales, that how much net profit I earn and from the net sales. So net sales will be including total sales minus sales return. Any kinds of sales returns will be there for a company. So that will be deducted in that. Okay, so formula for this is net profit ratio is equal to net profit divided by net sales into 100. Next is operating ratio. So this is also an important profitability ratio. So which will tells us that what is our operating ratio, what is our company's operating. So operating ratio is equal to cost of goods sold plus operating expenses. At what cost and goods are sold and what are my operating expenses. So that will be together divided by net sales into 100. So how much is my net sales, and with that will be multiplied with the 100. So this is about the operating ratio. Okay, so in next unit, next subunit, we will look into that. What are the in next unit we will see that subunit how we are going to calculate these ratios with the one problem. Okay, so that's it for the day. Thank you for attending. Have a good day. Thank you.